The Fed left rates where they were, then the market moved the other way. Brent was up 6.14%. The Treasury yield ended at 4.687. The S&P was down 1.52%, and VI gets was up 13.45%. Look at all of that together. Oil moved higher, rates moved higher, and stocks moved lower. The Fed did not raise rates. The market still made it more expensive to hold risk. If you only read the Fed headline, Wednesday looked unchanged. If you held growth stocks, it did not feel unchanged. Tonight, I want to show you where that tightening came from, who paid for it, and the levels that tell us whether it carries into the next session. AP said the Fed left its benchmark rate near 3.6%. It also said 3 officials wanted a rate hike. The decision left rates unchanged, but the vote showed more concern about inflation inside the Fed. At the same time, AP reported fresh Iranian missile attacks and US and Saudi strikes against militias backed by Tehran. AP said Saudi energy facilities were attacked, and the Strait of Hormuz remains effectively closed. The Fed held the line on rates while the oil market dealt with a supply shock. Higher oil prices can feed inflation. Higher inflation can push long-term rates higher. When long-term rates move up, growth stocks usually take the bigger hit because more of their value comes from earnings further out. That is the chain to test against the market, and every link showed up Wednesday. Start with Brent. It began with an 83.02 prior close and never traded below 83.295. It hit 88.221 on 2.2 up 6.24%. Look at where the bar closed. The market did not spike on a headline and hand the move back. Brent finished near the high, which means the energy premium was still being paid into its daily close. That matters beyond an oil position. Crude is an input cost. When the barrel gets repriced higher, the market has to decide whether companies absorb it in margins, pass it to customers, or slow demand. None of those choices is friendly to an easy inflation story. The producer side caught the benefit. Its LE came off a 57.57 prior close, traded from a 58.42 low to a 59.30 high, and closed at 58.65, up 1.88%. That smaller gain than crude is useful. Integrated energy companies sell the barrel, but their shares still carry stock market risk and a discount rate. The sector rose with crude but lagged it, consistent with broader equity pressure. The immediate test is simple. A Brent close above the session high says the premium is extending. A close below the session low weakens that premium. The full energy inflation channel only unwinds if the Treasury yield also loses its own lower level. Now look at the Treasury market. The previous close was 4.606. Wednesday opened at 4.622, reached 4.696, and closed at 4.687. The low was 4.606. The key point is what happened after the Fed decision. The longer-term yield moved higher and held most of that move into the close. The Fed controls its policy rate. The market sets this rate, and it matters for company borrowing and the value investors put on future earnings. Oil and yields moved higher together. A Gailey bar cannot prove which flow led. The pair still fits an inflation reading better than a simple growth scare. When oil jumps and yields fall, the bond market may be looking at weaker demand. Wednesday gave us the other setup. Oil up, yields up, growth down. The link to equities is straightforward. A higher long yield raises the return investors demand from stocks. The further those earnings sit in the future, the more their value moves when that required return changes. Energy costs pressed company margins while the Treasury market pressed stock valuations. Grow, absorb both. The S&P prior close was 7,428.78. It reached 7,014.84, then broke to 7,030.1392 and closed at 7,036.15, down 1.52%. That close is the useful part. The index finished barely above its low, so there was no meaningful late rescue. Broad risk sold off and stayed sold into the bell. The mechanism winds up. Oil raised the inflation problem. The Treasury yield raised the discount rate, and the index paid for both. A close below Wednesday's low would say the pressure is broadening. Holding above it would keep the damage inside the range already printed. The close location also changes the burden of proof. Buyers do not need a rally to stabilize the tape. They need to keep the index from accepting below the low. Sellers already showed they can push price there. The next session tells us whether that level attracts real demand or only marks where the clock ran out. Growth carried more of the bill. Nvidia made the duration story clean. Its prior close was 97.01 and its high was 97.01. The low was 90.01. The close was 90.01, down 3.55%. That is a stock closing on its low, while both oil and yields finished near their highs. A daily bar cannot isolate every flow behind the selling. Nvidia still underperformed the S&P as the Treasury yield rose, which is the relative move the duration mechanism calls for. Nvidia lost 3.55% while the S&P lost 1.52%. The difference is concentration. The whole index is not the same trade. A growth-heavy book felt the tightening more directly, and a flat policy rate did nothing to protect it. Closing at the low makes the next condition unusually clean. A recovery above the prior close would show Wednesday's damage being repaired. Continued acceptance below the session close would keep the pressure centered on the market's largest duration exposure. Volatility joined the broader move. VIX came in off an 1821 prior close, traded down to 1745, reached 2028, and closed at 20.25%. The close matters again. VIX did not spike and fade. It held near the high while the S&P held near the low. That is a coherent risk-off. Close energy stress came with higher yields and lower equities, while volatility stayed bid. If VIX cannot clear Wednesday's high in the next session, fear is contained inside this bar. If it closes above the high while the S&P loses its low, the market is priced in something broader. My read is simple. Wednesday was a shadow tightening. The Fed left its policy rate unchanged. The market still raised the cost that portfolios actually feel. Brent made energy more expensive. The longer-term yield made it harder for expensive stocks to hold their valuation. VIX stayed near its high into the close. The Fed decision describes the policy setting. The market action describes financial conditions, and those conditions tighten. The key question is whether oil and yields keep moving together. If that pair separates, the story changes. If both extend together, the market is doing tightening work on its own. Oil works through company costs and inflation. The Treasury yield works through borrowing costs and stock valuation. They do not need to move together every day. When they do, the same portfolio can take pressure through earnings and through the price investors are willing to pay for those earnings. XLE shows the other side of the move. Energy shares can rise with crude even while the broader index falls. That split is why the index headline gives you an incomplete picture of Wednesday's session. Now look at the market from the other side. If you own the S&P, the move in the index is what you see. If you own the stock, the move in Nvidia is what you have. That is a very different day. The same thing is going on with XLE. The price of oil is going up and the stock market is going down. At the same time, energy stocks are going up. We are going to look at the same market in the next section. If the price of oil is going up and the Treasury yield is going up as well, we have the same trade. If either moves the other way, we have to take another look. The daily close is what we are looking for. That is the part I care about, because the close tells us if the move can continue. Here is the map for the next close. Base case, Brent stays between 83.95 and 88.59, while the Treasury yield stays below 4.696. That leaves the energy shock contained inside Wednesday's range, but conditions remain tighter than the Fed headline implies. Escalation, Brent closes above 88.59 and the yield closes above 4.696. Then watch 7,313.92 on the S&P and 20.28 on VIX. An index close below its low with volatility above its high says the pressure is spreading. Day escalation, Brent closes below 83.95 and the yield closes below 4.606. That would show the energy inflation channel unwinding rather than merely pausing. They are conditional markers rather than price targets. Oil and yields settle the mechanism. The S&P and VIX tell you whether the rest of the market believes it. The Fed held, the market did not. Wednesday repriced energy and long rates in the same direction. Equities and volatility followed. That is what makes this more than a bad day in tech. The pieces agree. Watch Brent and the Treasury yield together after the next close. If they separate, reassess the story. If they keep climbing together, the shadow tightening is still on. No prediction and no trade call. Just a mechanism and a map with conditions that would prove the read wrong. If that is the kind of post-close breakdown you want, subscribe, and I will see you tomorrow.